In this video, I want to explain how risk arbitrage works. It has to do with profiting from mergers and acquisition. So risk arbitrage, also known as merger arbitrage, is an investment strategy that seeks to profit from the successful completion of mergers and acquisitions or other corporate events. So these are the key features of these strategies, of this particular approach. Number one is event-driven strategy. Event-driven strategy. This involves investing in companies involved in mergers, acquisitions, or other corporate events where the outcome is uncertain. In this case, the outcome may not be, all that ascertained, but all the same, you still invest with the hope that things will turn out fine. And if it does, you would then stand to benefit, adequately, tremendously. Number two is spread exploitation. Spread exploitation. The strategy typically involves buying shares of the target company at a discount to the proposed acquisition price, and possibly shorting the acquirer stocks if it's a stock for stock deal. The idea here is that you short the stock of the company that wants to purchase another company, and you go long on the stock of the company that is about to be acquired, because all things being equal, generally speaking, the acquired company will have a share price. The share price of the acquired company will then rise, whereas the share price of the acquirer, the acquiring company, would most of the times will drop. So you seek to profit from the spreads, therein. Number three is a risk of deal failure. It's a very key factor when it comes to risk arbitrage. So the strategy assumes the merger or acquisition will go through, but if the deal fails, the investor can face significant losses. That is it. You just hope and pray and believe that everything will work out fine, that the proposed deal will be successful. If it does, then you will make money. If it doesn't, the reverse will be the case. Number four is time sensitive. As time sensitivity, the profit or losses are realized over a relatively short time period or short time frame from the announcement of the deal to its completion or failure. It is not a long-term investing strategy, no. It's a short-term event from when the announcement is made to when the deal is concluded. So it is a time-based, endeavor. It's time sensitive. So let's look at the inherent advantages as well as some disadvantages of risk arbitrage. Number one advantage is potential for attractive returns. It can generate significant returns if the merger or acquisition is successfully completed as planned. If it is carried out as planned, then the investor will gain, will make money. Number two, market neutrality. In some cases, this strategy can be market neutral, meaning it can generate returns regardless of the movements of the broader market. It's market neutral. The performance is not, based on market conditions. Number three is exploiting market inefficiency. It's a very important benefit of this strategy. So it capitalizes on the price discrepancies between the current market price and the eventual deal price. The current market price and, when the deal is through, the eventual deal price. So you tend to profit from that discrepancy. Number four is diversification. It adds a different type of risk and then return profile to a broader portfolio, potentially enhancing diversification. You have your traditional portfolio and you could incorporate in a risk arbitrage into your portfolio to kind of diversify, you know, your returns, so to say. There's uh, there are drawbacks, disadvantages, and pitfalls that that's attributable to this strategy. Number one is high risk of loss. If the merger or acquisition fails, the target company stock may drop significantly, leading to a loss. The target company that you expect the price will then climb up, will go up. If the deal does not take place, the price may fall automatically. Number two, complexity. It requires an in-depth analysis of deal terms, regulatory risk, and potential obstacles to the deal's completion. So it has to do with tons of analysis, and equally consider regulatory, the regulatory environment might introduce element of risk into the whole deal. Number three is unpredictability. External factors such as regulatory decisions, shareholder votes, or changes in market conditions can affect the outcome. Sometimes shareholders may vote for or against a particular outcome, which would then have an impact in the overall return of these investments, this strategy. Please subscribe to this channel and give these videos a thumbs up. Number three is or number four rather, limited profit potential. The profit margin is often relatively small, as the spread between the current price and the acquisition price may be narrow. Usually, the spread is most of the times narrow because of the limited time frame. So you don't really expect an outsized gain compared to somebody holding stocks for 1 or 2 or 3 or a decade or more. The time frame from the announcement to the completion of the deal is usually very small, and the spread involved is usually very small as well. The profit margin is quite limited. So risk arbitrage is a specialized strategy that offers high returns but also carries significant risk, especially if the expected corporate events does not materialize as anticipated. Sometimes the deal may not be successfully carried out. In that instance, there's that possibility of one sustaining losses.